Hello everyone, welcome to my Cotton and Peanut Field Day video report. I'm Yangxuan Liu. I'm an assistant professor and cotton extension economist at UGA. Today we will discuss about the cotton market outlook and risk management programs for cotton producers. This presentation combines several projects that I'm working on with the funding from Georgia Cotton Commission and Cotton Incorporated. To start with, let's take a look at the world cotton supply and demand situation. The red bar in this graph is the world cotton supply and the black line is the cotton demand. For the past 2 years of 2018 and 2019, global cotton demand declined sharply. Especially for 2019 marketing year, COVID-19 severely impacted global economy. Real GDP in the U.S. decreased at an annual rate of 5% in the first quarter of 2020 and 32.9% in the second quarter of 2020. As cotton and cotton-related products are discretionary items, COVID-19 has severely impacted the demand for cotton. Retail sales in clothing in the U.S. experienced a 87% decline in April from previous year. Similar trends of the retail sales are also observed in the other countries. World cotton production in 2020 is forecasted at 118 million bales, decreased from 123 million bales in 2019. Global cotton mill use is forecasted at 113 million bales in 2020, increased from 102 million bales from 2019, but is still significantly lower than 2017 and 2018 levels. Another source of the supply is the world ending stocks. The world ending stocks for 2020 are projected at second highest level for the past decade at 105 million bales. Especially stocks outside of China are projected at the highest level for the past decade at 64 million bales. This increase in ending stocks outside of China creates further downward pressure for global cotton prices. In terms of U.S. cotton, the orange line represents the U.S. cotton production and the blue line represents the U.S. cotton demand. For the past 3 years, production has been outpacing demand, which resulted in the highest ending stocks for the past decade at 7.2 million bales for 2020. Exports for 2020 are currently forecasted at 50 million bales. On average, over 80% of cotton produced in the United States enters into the global market. The decline in global cotton demand, trade uncertainty, and economic recession due to COVID-19, all these factors combined create downward pressure for U.S. cotton prices. We're not sure how long the pandemic's negative impact will continue and whether it will be a second wave pushing the U.S. economy into another round of decline. Cotton prices recovered a little bit since the bottom back in April. However, USDA is not very optimistic about the prices for the 2020 crop. The seasonal average farm price is projected at 59 cents per pound in 2020. In 2019, it was 59.5 cents per pound, and in 2018, it was 70.3 cents per pound. Because the cotton prices is so low, the governmental safety net programs are especially critical. Several programs are available to cotton producers. They are the ARC and PLC programs, and the loan programs, and the LDP or POP payment. This year is the first year that we have seen any POP payment since 2016. Here is some updates related to the ARC and PLC programs. The projected PLC payment rate is 6.14 cents per pound for seed cotton. The ARC County projected marketing year average price for seed cotton is 30.56 cents per pound. Last year, we released several publications funded by the Georgia Cotton Commission covering the topic of the ARC and PLC programs. These publications are available in the Georgia Ag Policy webpage. For the commodity loan programs, we released one publication back in March of this year discussing in detail about how each program works. Since then, we have received a lot of questions from county agents about the choice producers face whether to put cotton in the loan or take the pulp payment. Dr. Robertson and I ran some numbers and analysis this summer to answer this question in a second publication. The new publication is currently in the editing process through UGA extension, and it will be ready soon. One of the cool features that we did in the second publication is that we built a decision tree about different price scenarios and what is the optimal decision to make between the pulp payment or put cotton in the loan. It depends on whether the adjusted world price, AWP, is higher or lower than the loan rate, and what is the anticipated direction of the price movement, and the storage cost compared to the increase in price. The blue boxes show the optimal decision that producer can take under each price scenarios. Thank you for watching, and as always, if you have any questions, please feel free to contact me. Thanks again to Georgia Cotton Commission and Cotton Incorporated for their funding support. Also, thanks to Georgia Peanut Commission in making this video arrangement.